Jack, can we start with you?
Sure.
Yeah. Jack, say something.
All right, are we on?
Yeah, we're on.
Okay.
Say
I was
on.
enjoying our three-way conversation. I didn't know everybody else was, jumped on. So now everybody else can play along.
we
So,
wanted, we
welcome.
wanted Jack to start because he's got the most patriotic flag. So go ahead and dive in. And just as a reminder, as everybody's ramping on here, thank you for joining. Use the Q&A only to harass us, and I'm sorry, that's the chat. I'm already confused. Use the Q&A when you've got questions, and use the chat to harass us. So go ahead and take it, Jack.
Well, I was thinking that, today that we would just kind of totally go off script and talk about Cam Newton and New England and, about all kinds of other stuff about people going to the beaches, not wearing masks and things like that, but not really. So don't hit the leave button, leave video button. And for those of you that were, hell yeah, let's talk about that stuff. We can talk about that stuff offline at some point. So I would say from my perspective, not a whole lot new has happened in the past week, other than an extension of time on the June 30th date, which is significant, but I think for most people on these calls is not relevant because you're already in the mix, and we're talk about why, who that is relevant for. But I thought that we would start out with going through some statistics that I think are interesting as of the end of the month, as of July 1st, essentially, and kind of the numbers that are out there, and the remaining balance, as Gary has said in his emails, that so. There was initially $349 billion gone in 2 weeks. There was a second installation of $310 billion that lasted longer than anyone had predicted. There was a real push at the end of June. So between June 20th and the 27th, $3.8 billion in loans went out the door. So that was $10 billion in total loans dispersed for the month, according to the SBA data. And then, as you guys now know, there's $130 billion or so dollars still in the government's bank account. And so, the commentary on that is that, this is a short-term solution, that there needs to be a long-term solution to support payroll, businesses, et cetera, moving forward. There's some thought about using that $130 billion maybe towards a larger fund for payroll tax credits and using it in other places. But there is an understanding, acknowledgement in Congress that there has to be more. There is what is called the Prioritized Paycheck Protection Program, because we need more acronyms in our lives. And this one for short is P4. Capital P, numeric 4, and then what they are trying to do is potentially authorize a second round of funding. So what they've done is they've extended the time for people to jump into the mix for the original funding, but this would be a separate fund funded separately moving forward. Now, would they take some of that $130 billion and move it over? That's a possibility, and so. One thing that was mentioned, and the U.S. Chamber of Commerce is pushing on this, and this has been a question that has been raised on a couple of our calls, which is, what about the chambers of commerce and the C6s? The C3s were included, but C6s were not. So there is a push and a continuing push to, well, how about us? It's our turn. So throw C6s into the mix of things. So there's that's going on. There is, some more statistics, and the numbers: 4.9 million loans, $526 billion, with $130 billion left. And so some people said, what is the point in providing an extension? So the reasons for the extension, and there's a new term, maybe to me, maybe not to you guys in the accounting world, the DIY taxpayers, the do-it-yourself taxpayers, that says were drastically impacted but didn't have immediate access to tax professionals or bankers. And by the time they did, the bankers and the tax professionals were like, sorry, we're really busy and we're going to put you on the back of the list. If we get to you, we get to you. And there is a statistical link to smaller business owners and minority-owned businesses as well. So what they're doing with that is they're saying, okay, well, there is a reason for the extension of time and potentially the extension of money, because hopefully the government, the government, are going to get it right this time in the implementation and the access and everything else. And so there's that. As a side note, there is this automatic forgiveness proposal on the table, where that if your loan was $150,000 or less, that if you sign a one-page attestation that you're good to go, you didn't break any laws, etc., and that's my paraphrasing, then you're good to go. That hasn't passed. There is a key provision in there that says to lenders that we're not going to hold you accountable. Like if it's under 150, you get this piece of paper that's signed, we're not going to come after you. We don't expect you to do any significant due diligence. That is on the borrower. That is basically saying, under penalties of perjury, under federal law, I did everything right. I applied for it correctly. I got the money correctly. I used it correctly, and I did the numbers correctly on the formulation. So that's for that. And then some more statistics that 3.7 million of the loans are for $150,000 or less. So essentially 85% of all PPP loans. Now here's an interesting statistic. So that's the number of loans. As far as the amount of funds delivered, though that 85% only accounts for 26% of the actual funds that were dispersed. So what that means is you have a higher concentration, or I'm sorry, a lower concentration of higher dollar amount loans. I don't know if that maybe translates to that, does that mean there's less scrutiny if you don't fall into the larger loan pool of people? And there was that question weeks ago, and they put that $2 million number in that basically said, okay, if you're under the $2 million, you're okay. So now they're putting in another limit. And it's in line with what we've talked about in the past, which is that the government doesn't have the capacity to go and knock on everyone's door. So again, a jack theory that if you it's a smaller loan and you don't have any red flags that are algorithmic red flags, you put in the numbers correctly and it's within parameters, and no one rats you out for either legitimately or not legitimately, you have an angry employee, then you're probably going to stay off the radar of the IRS and Treasury and the SBA, but no promises. So let's see if there's any other interesting statistics that I can share with you guys on any of this. So, oh, yeah, here's a good one. The SBA several days ago, probably about a week ago, said, hey, people have been asking us to disclose the list of borrowers under the program. So tossed back and forth within the Senate, within the House of Representatives, and apparently they came to a bipartisan agreement that they would disclose your names to the public, and it would be business names, addresses, the NICS codes, zip codes, business type, demographic information, nonprofit information, job supported, and loan amount ranges. And then they give ranges: 150 to 350, 350 to 1 million, 1 to 2 million, 2 to 5 million, 5 to 10 million. And the reason being, and the 150 to the 10 million number represents 75% of the loan dollars approved. And then the 150, below 150 is just lumped into zip codes and some other, I guess, non-readily identifiable information just for statistical gathering purposes. So thought that was very interesting. And one other thing, and I'm trying to head off some of the questions that you guys may have on the line. A question has come up a couple times on the FTE safe harbor rules. And that, as you will recall, is that you, in one circumstance, you extend the invitation to come back to work. The worker says thanks, but no thanks, and you document it, and it should relate back to a COVID-19 reason. They didn't feel safe, they didn't feel the workplace was safe, et cetera. Then they added this other provision regarding requirements by federal agencies that you as an employer may not be able to maintain, and that's in the eye of the beholder, meaning not just you as the business owner, but your employees as well. So I'm going to read two little sections that are actually in that 35-page document that we talked about last time, which is the further guidance that came out. So there is a section that says the administrator, in consultation with the secretary, interpreting the exemption to include both direct and indirect compliance with COVID requirements, because a significant amount of reduction in business activity stemming from COVID is the result of state and local governmental shutdown orders that are based in part on guidance from 3 federal agencies. What they're saying is that we're imposing this on you, and there should not be a penalty if human beings don't feel safe in the workplace. And then there was further comment that said, you got to document it. And we've been saying that from day one on this program, that such documentation must include copies of the requirements or guidance, meaning from the CDC or wherever else it is that you're using as the basis for each business location and the relevant borrower financial records. So you have to have the cause being the CDC requirements, the other health requirements, and then you have to show the impact. You have the cause, you have to show the effect. So show the impact financially in your records, that this is the reason why we are not ramped up and getting the revenue, or that essentially that we have workers that are not coming back to work for us. So I think that covers kind of the highlights that I wanted to kind of get out in the first few minutes of the program, because these seem to be common questions that have come up over the past week or so. So I will stop there.
Adam, you have any commentary?
Yeah, I guess you could say it's directly related to PPP. Another thing that's started to come up is people are hitting loan renewals. We talked about how there's a possibility that, banks at the end of the day, and again, if we have bankers on the phone, please don't get pissed off with this. It's like they're trying to make a determination, rightfully so, about what their risk exposure is going to be going forward. So, if you're that type of business that your new normal is 75% of what it is, and that's probably going to be for the time being, it could be that the parameters of what was approved on your original loan, using a line of credit as an example, could very well be different now that you're in your, new normal. And where this really came up is, we had a client that had a conversation with their bank this week, and, in consultations with us, they've got 2, loan covenants associated with the line of credit. And in consultations with us, we talked about possible add backs. And one of the add backs is, what was the bottom line, since one of them was basically effectively a debt coverage ratio, which is how much you make relative to the principal payments on your debt. That's a common loan covenant. And in this case, they were going to pass anyway, but we said, well, look, you probably ought to go ahead and take a look at quantifying what was the bottom line impact of COVID had you just had the same year as last year. And it wasn't a huge number in this company's case, but it was still very quantifiable because their sales are very predictable, and they were down because the businesses they served were effectively shut down for a couple months. So what was interesting is the bank said, no, we're not going to use that as an add back. And it's like, well, I don't know what is more one time than a freaking global pandemic in a government shutdown. And we didn't get into it, but the other funny thing too that I started thinking about, I wasn't on the call, but the other funny thing that I started thinking about is, the same client, because we had a lot of questions about when should I start presenting this information on my financial statements? Because, we don't have anybody that's actually had loan forgiveness approved. So, and we also don't know which expenses are deductible versus not. So it's hard to know exactly what are we adding back or not at this point. So the same client could have also relieved the debt as an other income item on their financial statements, and that would have more than offset what they added back as their bottom line impact. My point saying is that, Jack's talked about the documentation for the purpose of forgiveness. I think we also need to be thinking about documentation and plans for your banking relationships. And I mean, in this case, it's going to be the same bank that gave you the frickin' PPP loan in the first place. They're just trying to assess, all right, well, we burned through those funds. What's your long-term viability at this point? Appropriately so. It's just, if you haven't already started having these conversations, it's a good time to start thinking about, well, what's my story going to be in terms of how I'm going to explain what my future is going to look like. Because I think the reality is that, given that, the first day that you get PPP funds, I think was April 3rd. It was either April 3rd or April 7th. I can't remember exactly. But, if you think about how you carry this forward in terms of the application forgiveness, call it maybe 50% of us will have gone through also a line of credit renewal at that point, where we're going to have to demonstrate what we look like and what we're going to do, which may be different from the original basis of the loan. So just, keep that in mind, in terms of, if you're thinking that was an access to available funds, I'm not trying to say, oh my God, start panicking now. At the same time, just have a good plan in place, because there's a very chance that banks can ask some pretty detailed questions about what your future plans are, depending on their credit exposure.
Sounds good. You guys ready to rock and roll on some questions?
Let's do it.
Yeah.
So this one came in yesterday, actually, from Mark. And so I said we would address it today. So he says he's got a couple questions about PPP forgiveness applications. So one is, the EIDL advance amount does not refer to the $10,000 grant. Is that correct?
That is the $10,000 grant. I mean, the number varies based on how many employees you have, but the max is $10,000, and that's what they're talking about. And that they've been, I think, fairly specific with that in the subsequent guidance that's come out from the Treasury.
All right, next question from Mark was line 9, compensation to owners. We have 4 owners, but only 1 is also an employee. If we enter the employee owner's comp on line 9, we lose the FTE credit for this owner on the Schedule A. Is this line for draws versus is this line for draws versus owner employee salary? The line is for owner employee salary, because that was what was included in your original request. And I think our guidance in terms of how the count is impacted is that, just be consistent. If you're including the owner as part of the average FTE count in your average FTE count, include it. If not, don't. You're not penalized as owners. You don't need to be worried about being penalized. And the reason that we have that as kind of a basic conclusion was all the subsequent guidance that came out around owners being enriched, which is why the owner salary was capped. And all of that had to do with the FTE count component. So clearly the intent of the Treasury is that, owners should count
but should not be unduly enriched because of this. Is that fair with your take, Jack?
Yeah, and that's why there's the 15K, the 20K limitations and on the forgiveness. So yeah, I mean, it's meant to be so it's not a double count. Understand there's some confusion, and it's, you know, we answer these questions, but we make certain assumptions. Are we, when you say paid to the employee owner, I mean, is it an S corp? Is it truly a W-2 wage earner versus it being in advance on the distribution at the end of, you know, say an LLC that's treated as a partnership? So, you know, just providing the guidance, but it really depends on your circumstances in the tax treatment of your company.
All right, this question is from D. We used all our PPP funds. Are we required to continue paying our laid off employees?
I mean, no, but when you go back for the forgiveness, you're going to have to fall in one of the exceptions if you haven't hired them back by the time you're applying for forgiveness.
Yeah, but let me ask you this. So, and this is obviously rhetorical since we can't get a response maybe, but okay, so laid off employee, you've used the PPP money, assuming that they haven't gone to get unemployment themselves, right? So there has to be a matching, it can't be a double benefit. So, you know, laid off employee, I'm assuming they are not on unemployment, therefore they're receiving these funds. So they're still technically an employee, but so I'm confused as to, are they a laid off employee? Why are you using PPP money necessarily for that if you haven't hired them back? So maybe presuming that you're going to hire them back and then fire them the day after the covered period, you know, so again, fact specific, but so anyway.
So on this one, D, if we have not answered your question, hit us up at FAQ@TrustBGW with even more specifics, and we'll get back to you, okay?
Yeah, and this may not have been, you know, this may not have been the question, but somebody else may have it, is that, you know, and this kind of goes back to what Jack was talking about with second wave of stimulus. The extension goes for people that didn't ever get PPP loans in the first place, but if you spend all the money and, you know, the crap still sucks for you, that's what the second stimulus is really supposed to be all about, especially in light of the fact that we're, you know, we're in, you know, whether the first wave never got fixed or we're in a second wave, you know, whatever the case may be, we're starting to scale stuff back. Funny side note, Gary, you'll appreciate this one, but on CNN last night, I think it was during Andrew Cuomo's show, they interviewed the owner of Mountainside Fitness in Phoenix, Arizona. And I used to work out at his very first gym because it was by my parents' house. And he spotted for me because he was like one of the only employees at the time. It was a pretty small gym. When I was doing incline presses, and told me that my arms were too wide. Anyway, funny side note, I'm like, you've come a long way. Now you're on Andrew Cuomo. I was 20 at the time, so that was 27 years ago. Anyway, sorry, I might even been a teenager at that, or still in high school at that point. But it, you know, really, I think what we're going to see is that, look, I mean, you spent the money, you know, rightfully so, but you're still not recovered. So you're going to have to let people go. And that's, to Jack's point, for you to get the forgiveness amount. If you haven't gotten forgiveness at that point, you spent the money, you're not going to hit the FTE count. So you're going to have to be prepared to support one of these exceptions for the FTE count, or hire everybody back, which in and of itself is an exception.
Yeah, I would say it's hard to we don't have crystal balls to understand how the next version of stimulus is going to manifest itself with respect to the current stimulus package. So if you recall, you know, the EIDL program was first in time, and then they put together the PPP program, and they said, well, and now we're going to take the first, you know, you can't double dip. So your first 10K of the EIDL program, is kind of essentially PPP money. And so, does that happen now? Does, in the scenario where you've used all the money and you want to continue moving forward, one part of me says, well, draw a line in the sand. That's program one, and program two is coming. So that way we have some finality. But there's also the possibility they start merging things together, because maybe it makes sense to do that in the scenario where you have a gap because you've used all the program A funds, and then they're going to infuse more money into that and allow you to use it for that gap period and the period moving forward beyond the 24-week period. So there's no way to tell. And it kind of goes back to what we've been saying. The question is, I've done everything that I need to do. I'm within the money, the worksheets, the spreadsheets work. Should I go ahead and ask for forgiveness? And, if you're absolutely sure, then yeah, go ahead. But it's just, there's so many possibilities of the program changing that if there's no need other than, there's certainly a lot to say about peace of mind of just having it done, checking off the list. My wife says all the time, touch it once and be done with it. Don't fester about it, think about it, your options, just get it done. And so, there's that's a possibility, but I just, this is kind of rehashing something we've talked about in the past is, if there's not this burning need, then it's kind of still a wait and see process for most people, I would think.
Yeah, the example with Mountainside Fitness, this is in Arizona. The reason for that is, they allowed gyms to open up, and they did, and then they shut them again. So that is a likely scenario that could happen, with us, or if you have a business in South Carolina, I could see that happen in South Carolina. It's unfathomable to me that they shut down all the beaches in Dade County in Florida for 4th of July weekend. Like, that's just unbelievable that, politics has been part of this. It's kind of unbelievable that Republican administrations are shutting stuff down. It's like, that means that it could happen anywhere, I think, at this point.
All right, next question is, my 8-week period ended 6/29. I hired someone during this time to avoid the FTE forgiveness reduction, but I haven't spent all the money yet. I can spend it all in 1 month, but can't afford to keep him the whole 24 weeks. Will I be penalized if I let him go in the middle of the 24-week period? Also, do I need to complete the forgiveness application first?
I think this sounds like if you were going to have to be beyond the 8-week period, and right now we believe it's kind of, you're either on 8 weeks or you're on 24 weeks. If you were beyond the 8-week period to deploy the money, then and you're going to run out of funds, I think you're going to hit into that scenario where you're just going to have to accept the fact that you may not pass the average FTE count. So your exception that you're going to apply for, check the box on, is either going to be, I've hired the people back by the time I'm asking for forgiveness, or alternatively, conditions existed such that I can't have the position anymore.
All right, next question is from David. The form asks for owner's wages. For an S Corp, does this include both wages and K-1?
No. And it's also important to say, too, health insurance doesn't count for an S corporation either, because, rightfully so, it was already in their W-2 in the first place. I could make an argument all day long that that's BS, because, it's in your W-2 in the first place, but it's not fair that I've got an employee that I can count $100,000 plus health insurance, but if I'm an S corporation owner, it's $100,000. It's only $100,000 period, but I didn't write the rules.
Next question from David is, if the company started during 2019, so it had a partial year, is the owner's wages prorated somehow? If they receive $20,000 in 2 months, can they claim a larger $120,000 total comp?
I mean, they couldn't anticipate every single scenario. When they talked about the owner wage in 2019, they were talking about a full year, I believe. So I think you'd have to, that would be one where I would go for it, understanding that I might have a problem, but at the same time, you're capped out at $20,500, whatever the number is anyway. I think in that case, as long as you're not asking for more than what your annualized number would have been had you been open the whole time, you might have some questions, but I could stand in court and defend that.
And you'd want Jack by your side.
That's right.
Stand in court. Just saying.
I have a big smile on my face. It's all good.
Next question is, we elected the 24-week covered period to get us to 100% of forgiveness. Is there any downside to using just payroll costs to report for forgiveness versus reporting all eligible costs? Using payroll reports as documentation is super clean for us and easier than compiling utility invoices, et cetera, or will we have to report everything?
I don't think you have a downside. Do you think, Jack?
No, let me make sure I understand. 100% was used just for payroll and not other costs. So, I mean, I go back to the fact that the 25%, now 40% was just, a maximum on non-payroll costs. So, keep track of everything, because they may say, well, wait a minute, why did the numbers don't work right or whatever it may be. But I mean, I think that is probably your way in the safe zone if you're saying you're using 100% on payroll, so long as the numbers and formulas work out in that fashion, meaning you haven't gone over the maximum per employee and those kind of things.
Yeah, I think the spirit of it was it's the Payroll Protection Act, not Utility and Other Items Protection Act. I think that was just to try to help offset. So sounds like they are in the happy zone there.
But Gary, that brings up an interesting point in that, does the second set of stimulus focus more on those other costs? Because, people are having issues with rent, and there are varying degrees of cooperation by landlords, at least that I'm experiencing, that my clients are experiencing, both on the landlord and on the tenant side, franchisor, franchisee side. So basically the borrower and lender side of things. And so, there is discussion about that even though they might call it the P4 or whatever it was, as payroll protection, that maybe is there a higher concentration on non-payroll costs, acknowledging that there are those costs that need to be handled, that you can pay people, but if you can't get your business through its ordinary expenses, then there's going to be no business. So it doesn't matter. So I think that the whole process or thought process has evolved into, originally it was to put money in individuals' pockets and subsidize that obligation of the employer to do that in a situation where the employee may not be able to come back to work, or there's no work to be done. I think that this, they may even change the name of it, and as I said, focus on some of the non-payroll expenses in order to really provide a stimulus to the business versus putting money in individuals' pockets. But again, Jack theory, and I don't make the rules.
Okay, this is from Robert. For the PPP, would an S Corp with the owner as the only employee be a disqualifying factor? Cabbage has turned down a business owner for this fact. The owner takes both W-2 wages and distributions. They're under the $100,000 W-2 figure.
It's not a disqualifying fact. It may be just Cabbage isn't comfortable. I mean, we've had cases where Cabbage didn't fund the full amount that someone could have qualified for. So the only thing that I can think of there is that Cabbage just made its own kind of arbitrary internal decisions relative to, hey, that's the law, because we've got a lot of single owner S corporations that have been funded.
Yeah, I'm not aware of a formula or an algorithm that says when you have an S corp, this is what is absolutely the max, minimum or max that you can give to an S corp owner as W-2 compensation, and conversely, what can be a distribution versus wages, hence avoiding payroll tax. And so, it sounds like that maybe there is some sort of internal qualification. I don't want to say discomfort, but maybe that's what it is. But it's because that is subjective, that maybe that's what the heartburn is going on there in the background, is that, if they did it right, it's a gray area where there's no bright line. So maybe that's what's going on. But I'm not aware of a rule that says, party of one in an S corp ownership is a disqualifying event.
This question is from Ray. Apologies in advance if this has already been answered. In regards to headcount, the easy forgiveness form says employees at the time of forgiveness application. We'll likely have to lay off some employees the day after our 8 weeks is up, but we will have spent all the money. So obviously by the time we actually apply for forgiveness, our headcount will be down. Does the headcount requirement end when the 8 weeks is up?
We believe that the headcount requirement is up when your covered period is up.
That is well stated. I was going to say, yeah, it's 8 or 24 depending, but it says that they've chosen the 8 weeks. It's the way I understand it is you are looking back into a finite period of time with all of these calculations. And so when you ask for forgiveness, there is a time, a deadline to do that. And then there's a process that the bank and the SBA has to follow, but you're looking back at that finite period for all of the numbers. And so that's why there's discussion as to, okay, this is great, and it provides money and puts money in people's pockets for 8 weeks, 24 weeks. But what happens on +1, the day after? And, is there a way to create a stimulus package that allows for that so it doesn't happen? And so that's where I think Program B comes into play, which is you have owners that say, I can't afford, thank you for the money, I can't afford to move beyond this period of time that has been subsidized. So hence I need more subsidy or else I can't make it. And so there will be strings attached to Program B in that money. And it may be similar to the fact that you reemployed somebody on the last day of the 8 week or the 24-week period, you fired them, but then you have to bring them back and pay them, backfill their pay with package B money or Program B money. So again, numerous possibilities and outcomes, but I think that one of the objectives of the next plan has to be that it's retroactive to the end of the 8 week and 24 week period, because they are, from what I have read, that Congress really, even though they're talking about it, they're really not going to pick this ball back up until probably mid-July, partially because of the holiday weekend or holiday week and vacations, but they're just, everything is okay now, I guess, from their perspective, and that they're just not in a huge hurry. I think that is partially fueled by the fact they don't want to get it wrong again. They want to learn from the mistakes. They want to put together a program that and they're learning from their mistakes and how they implement it and make sure that there aren't the abuses potentially. We haven't talked about this, but there's Gary had shared with us an article about some big companies filing for bankruptcy after they got their loan money. And there's a rule that you can't get loan money while you're in bankruptcy. In other words, to essentially the federal government to be your lender while in a bankruptcy matter while you're in bankruptcy. But there's a loophole, and I'm not suggesting that you all run out and file bankruptcy after you get your money or after the forgiveness period, but because there's gonna be consequences to that. They can't allow, similar to weeks ago when it was found out that people who didn't need money were getting it because they were liquid and had plenty of assets. And there's going to be, I think, consequences to those who took the money and ran up to the federal bankruptcy courthouse to file their petition for bankruptcy.
Speaking of errors, I don't know. I don't have the easy form in front of me, and Jack, you may have it at the touch of your fingertips right there, but here's the question. Also, is there an error on the easy form line 7? Shouldn't it be 60% of the amount of the loan? I don't know if that means that it's at 75% instead of the 60. I don't know.
No, I'm not speaking to that. I can't speak to that line off the top of my head, so I'll stall while Jack brings it up. But so basically the way the forgiveness application works is the first section talks about, well, what were your payroll costs? So you add those things up. And this is the easy form, so presumably you did not have an FTE problem or a salary problem. And then the next section talks about what was your ratio of payroll costs to other costs. And if you were off there, then the maximum loan forgiveness would be whatever the payroll cost is that you calculated, I believe divided by 0.6, not the loan forgiveness amount. So basically just trying to self-impose the forgiveness amount to be a function of your payroll costs that you actually did spend, which gets to the, was it all or nothing at 60%? No, it could be 50%. Just accept the fact it's still going to be a ratio. Meaning, go ahead.
No, I was going to say, you're correct. I mean, it's meant it to be a gut check on whether you hit the number. And so, you take what your total payroll costs and then and see what the forgiveness amount is to see. So it's a calculation essentially. So I think that number, the way it's stated there is correct, but potentially could be misunderstood. So thank you for bringing that up.
Okay. This is up from Rob. A single member LLC being taxed as a partnership, how would someone go about applying for PPP funds when they do not report any W-2 income?
Well, that's on a Schedule C. So that's the equivalent of self-employed sole proprietorship.
All right, next one is
meaning there are instructions for that, and the punchline is your maximum forgiveness is $20,500 ish, round numbers.
Still waiting for the bank to say I can apply for forgiveness even though the time is up. Says they're waiting for the agreed upon form from the banks and the SBA. Is this correct?
Well, I mean, we have a form. I think it's more around they're trying to shake out how do we process this internally. So there may be a delay in terms of the forms between the SBA and the bank, but I mean, you have an application form. I don't think we see it changed a whole lot. There's just more clarifications that come out about what you should put where.
Yeah, and I'm not sure. I mean, the question was the time is up. I mean, the only time that is up and actually isn't up now because it's been extended is the application, unless you're talking about the 8 weeks being up versus the 24, but that is the covered period. That is not necessarily the time that you need to apply for forgiveness. So I think that the banks are, to Adam's comment, still trying to figure it out, how to process it, and kind of in the back of their minds want better clarity on what their liability is what their responsibilities are and what their liability is in processing forgiveness applications. Because remember, it's, you know, they lent out their money and they're seeking reimbursement from the feds for those funds that are out the door. So the hole that exists currently is in the bank's bank account that needs to be filled back in by the federal government.
Yeah, and remember, based on the law, you've got 10 months to apply. So I mean that, you know, fact check me, Jack, but even the earliest loans technically have until February of 2021 to submit their application. So I mean, it's not like nobody's in a, as an owner of a CPA firm who is both thankful that they extended the tax deadline, but then also pissed off that they extended the tax deadline on July 15th, because we're notorious. You know, our clients procrastinators, but we're not any better. Oh, we got more time. Woohoo! Anywho, you know, I think there's something to the fact that this 10-month window, pretty much everybody said, woo, don't need to worry about that crap right now. You know, let's wait a little bit, because like nobody's going to die if we don't process an application right now. You know, let's kind of catch our breath a little bit, you know, get through our loan renewals, get through this other stuff.
Next question is, as of now, I've used all my PPP funds after 10 weeks, 90% on payroll, so I'm good there. My FTE count is down 10 employees, so I'm hoping business picks up prior to December 31 and we can hire back. If it doesn't, can I just hire 10 people at the end of the year to get them the exemption, and how long would I have to keep them on board?
There's no bright line on how long you keep them on board. You could qualify for the exemption if you hired them back, but you could also look at that. If it was me in that same position, my first call wouldn't be hire people for the sake of hiring people. It would be, look, you know, can I show the correlation between, you know, CDC guidelines, state order, or whatever, and why I can't hire these 10 people back? That I would try to exhaust that first before I went to the let me hire people for the sake of hiring people so I can turn around one day later and whack them.
Yep. Next one is from Kim. Do I have to choose 8 weeks or 24 weeks right now? Can I switch back, or can I switch from 24 weeks back to 8 weeks at the end of 24 weeks?
Well, I think you're just electing 8 or 24, and you apply after 10 months from receiving the funds. And I mean, you know, I think we've had some questions in the past about, well, what if I use the funds in 12 weeks? Do I use 12 weeks as the annualized salary dollars? That theoretically is correct, but it's silent on what you do if you have a less than 24-week period but greater than 8-week period.
And I would add to that, there's a bit of an assumption in that question that you have a choice. If the funds were received after June 5th, then it's a 24-week period. If it's prior to that, then you have a choice. And so there's that variable as well, because that's when the next version or the clarification, the flexibility act was put into place, which you know was clear about the 24 weeks. But then if you receive the money then after, then it's 24 weeks.
Okay, next question is, we have PPP loan for an LLC, and the PPP loan amount included partner income. Do we use the current loan application and report the payments to the owners on the the owner-employee line, or is there going to be a separate application for businesses with self-employment income?
I think we're thinking it's the same application, and you report them on the owner-employee line, and that's primarily driven behind the fact that there's been all sorts of FAQs. Again, remember, there's more FAQ, more volume of words written about felons than there is owner compensation. That being said, they do talk about partners in the owner compensation guidance in the owner section. Thus, we are going to include them in the owner employee section.
So if anybody, we have gone through all of the questions that we received through email, as well as that came through today. Another question here, and it is, we got $7,000 labeled EIDG. That's a G and not an L. I'm assuming we do not need to pay any of that back, correct?
Yeah, I hadn't heard the labeling like that, but our assumption is that's the grant.
Yeah, it sounds that way. That's from Marguerite. Thank you. Any other questions out there?
While you're soliciting questions, there's, Adam had brought up something outside of the scope of kind of the numerics, which is, what does your business look like down the road from now? And part of that also is, what is going on actually in your office space and liabilities related to that. I've been going into the office a couple days a week, and I've watched the evolution of my office space. And I'm sure a lot of you have gone through this, where it's physical distancing, limited capacity in the break rooms and public space, and the meeting spaces, the conference rooms, the copy rooms. We're all wearing masks in the public areas and those kind of things. And, with that, it's, as employers, and we do that because as employers, as an owner in my law firm, we have a responsibility to our employees. But what happens when we miss the mark and someone gets sick and they're mad at us about that? And so, there's a lot of trepidation by business owners as to, okay, what is enough? What happens if I don't do this? Maybe I shouldn't have people come back. Maybe I should have them do remote access and those kind of things. And so, North Carolina and Georgia are kind of on the leading edge of, I don't want to say employer protection, but addressing that issue. And this was something that, and I don't know if this is how far this bill has gone in the state legislature and the General Assembly, but this is a report as of June 30th that both North Carolina and Georgia advanced legislation that would provide liability protection to businesses, government agencies, nonprofits, so long as they take reasonable steps to reduce transmission risk of COVID-19. Both bills are now awaiting the governor's signature. Iowa was actually the first state that enacted that legislation. The reason really is to provide a kind of a minimum layer, so that it's I think to avoid frivolous lawsuits. That I got it. First of all, it must have been at work. It wasn't because I went to the beach with a bunch of other people during the 4th of July, because, why would that be the cause? It was my employer that didn't provide the appropriate protection for me. And so really that's what it's for. So I'm not saying that there's now going to be a layer of protection if you simply provided MAP or a disposable mask or reusable mask at the front door, did certain things. There's no formula that is published necessarily by the legislature. You have to rely upon going to like the CDC website and look at those guidelines. But this is a way that I think state legislatures are trying to provide some assurances to employers that you do what you can, do the right thing. Don't do nothing, but do something. And that, it's, if you're not able to get to a certain level, it's not catastrophic. And so, we'll see where that ends up. And I think that once the legislature passes that there will be some discussion and maybe some regulations and guidance that's put out by the state agencies, state health agencies, probably in coordination with hospitals and other medical professionals that assist with putting together those guidelines. So just wanted to mention that. And then a totally random thing, I don't know if we have any more questions, but apparently businesses are facing coin shortages. And so the Department of Treasury, because they have nothing really better to do, you know, they have the whole SBA thing under control. They're going to double their efforts to replenish coins at financial institutions and banks as businesses. So those of you that are hoarding your quarters and dimes, please go ahead and roll those up and submit those to your bank to put them into your bank account. I guess the Treasury would really appreciate that, and they would be less distracted and can focus on SBA PPP issues.
Got another question in here. This is probably for you, Jack, from Robert. Do you expect that South Carolina will have something similar to the North Carolina bill on liability protection?
I would suspect that other legislatures will follow suit. It's in their best interest to do that, to maintain, to make business owners feel safe within their state borders. It's kind of like, okay, look at the economic warfare that goes on since we're 10 miles, you know, Uptown is 10 miles away from South Carolina. You know, I'm half a mile away in South Charlotte from South Carolina. So, you know, why did the training facility go down to South Carolina for the Panthers? I mean, so there's always the, wait a minute, what are they doing, and should we be doing that the same? So I would expect that there will be similar bills or processes put in place for owners to feel that they can bring people back to work without looking over their back and worrying about, and it could, you know, legitimate claims, but stuff that it's, yeah, did you get it at work? We did everything we could. You know, we told you to not, you know, to not have 10 people in the break room. And if there was already 9 people in there, then you should come back later, kind of thing. You know, it's just stuff like that, that they just don't want to deal with the minutia. So it seems logical that other states would follow suit, particularly South Carolina.
Yeah, it makes sense. Let's see if we got another one. Nope, I think we've answered that. So any other questions out there? It's almost noon. So happy Independence Day, everybody.
Thank you.
Yes.
No, I'm celebrating today. Yeah, he's crabby. But I'm really happy because today, 5 years ago, I returned back as a North Carolina resident from the 13 winters of Cleveland, Ohio. So I am super happy.
Oh, wow.
Yeah.
Welcome to the heat again.
Oh, hey, let's see here. We got another thing on chat real quick before we adjourn. Let's see. I think we got it all. All right, y'all. Have a safe, healthy, and happy 4th of July, wherever you may be, or wherever you are going. So take care. Thanks again for taking time for us. Oh, one other question. Don't blow your fingers off. Yeah.
Got it covered.
That's good. Take care, y'all.
Thank you.
Thank you.
Bye-bye.